2019 to 2024. Financial media calling silver a dead asset. CNBC saying gold is the only safe haven. Bloomberg running headlines about silver's lost decade. Every mainstream analyst telling retail investors to stay away from the volatile and outdated metal. Silver sitting at $22, $23, $24 an ounce, while the financial establishment collectively yawns. And in those exact same years, JP Morgan, the largest bank in America, the institution that paid $920 million in fines for manipulating the silver market, quietly accumulated over 1.2 billion ounces of physical silver. Not paper silver, not futures contracts, physical metal, sitting in COMEX registered vaults. That's more silver than any single entity has held in recorded history. More than the Hunt brothers at their peak. More than the entire nation of India holds. More than Warren Buffett accumulated in his famous 1997 silver play. Now, you might think this is just portfolio diversification, routine hedging. Maybe JP Morgan's commodity desk just likes shiny metals, right? Wrong. This is the most calculated accumulation play in modern commodity history. Because there's a pattern here. A pattern that's repeated itself in precious metals markets for over a century. A pattern so reliable, so systematically executed, that once you see it, the entire story of what's about to happen to silver prices becomes crystal clear. And we're in stage 3 of 4. The precious metals market isn't random. It isn't driven by supply and demand in any honest sense. It runs on a 4-stage mechanism that major banks have used to extract wealth from retail investors for generations. Stage 1, major financial institutions use paper markets to suppress the price of the physical metal. Futures contracts, derivatives, naked short selling, they create artificial supply that doesn't exist in the real world. Stage 2, while the price is suppressed, these same institutions accumulate physical metal at artificially low prices. They buy what they're telling you to sell. Stage 3, supply deficits emerge. Industrial demand accelerates. The paper manipulation becomes harder to maintain. Cracks appear in the system. Stage 4, and this is the crucial part. The institutions stop suppressing. They allow the price to explode, and they sell their physical holdings to retail investors who finally discover the opportunity at the top. We've seen this with gold in the 1970s. We've seen it with silver in 1980 and again in 2011. We've seen it with palladium in 2019. And it's happening again right now with silver. While mainstream media tells you to ignore the boring metal, JP Morgan is positioned for the largest precious metals transfer in modern history. 1973, Nelson Bunker Hunt and William Herbert Hunt, sons of Texas oil billionaire H.L. Hunt, start buying silver. Their thesis is simple. The U.S. abandoned the gold standard 2 years earlier. Currencies are being debased. Real assets will explode in value. They start accumulating. Quietly at first, silver is trading around $2 an ounce. By 1974, they've acquired 55 million ounces. The price starts moving. $3, $4, $5. But here's what most people don't understand about what happened next. The Hunt brothers weren't just buying futures contracts. They were taking physical delivery, actually removing silver from the COMEX warehouses. And this created a problem for the banks, who had sold paper silver they didn't actually have. By 1979, the Hunts controlled an estimated 100 million ounces of physical silver, plus another 90 million ounces in futures contracts. The price had reached $35 an ounce, then $40. Then, on January 18, 1980, silver hit $49.45 per ounce, a 2,400% increase from where the Hunts started buying. And this is where the pattern reveals itself. The COMEX, controlled by the major banks, changed the rules. On January 7, 1980, they issued Silver Rule 7, a regulation that limited the number of futures contracts any single entity could hold. But the rule only applied to new purchases. It didn't force existing holders to sell, unless you were the Hunt brothers. Then came Silver Rule 8. Trading on margin was suspended. Traders could only liquidate existing positions, not open new ones. The market became sell-only. The Hunts couldn't buy more, but everyone could sell. Silver crashed from $49 to $11 in 2 months. The Hunt brothers were forced to liquidate at massive losses. They eventually declared bankruptcy. And who bought their silver at the bottom? The same banks that changed the rules to crash the market. Stage 4 executed perfectly. The lesson wasn't that silver was a bad investment. Silver went from $2 to $49 in 7 years. The lesson was that when outsiders try to beat the banks at their own game, the banks change the rules. But when the banks themselves are the ones accumulating, the rules don't change. They just wait. Fast forward to 2008. The financial crisis hits. The Federal Reserve starts printing money at unprecedented levels. Quantitative easing, zero interest rates, bailouts for every major bank. Smart money sees what's happening. Currency debasement means hard assets rise. Gold starts climbing, and silver follows. 2009, silver at $14. 2010, silver breaks $20, then $25, then $30. By April 2011, silver hits $49.82, finally surpassing its 1980 high for a brief moment. The retail crowd finally piles in. Silver to $100 becomes the rallying cry. Every financial forum, every precious metals blog, every newsletter is screaming about the silver shortage. And then it crashes. 35% in 1 week. By June, silver is back to $33. By December 2011, it's at $27. By 2015, it's trading at $14. What happened? The same mechanism. The CME Group raised margin requirements 5 times in 8 days during April and May 2011. Each increase forced leveraged traders to either deposit more cash or sell their positions. Most sold. The mainstream narrative said silver was in a bubble that naturally popped. But look at who was on the other side of those trades. JP Morgan, the bank that held the largest concentrated short position in silver futures. The bank that had been fined repeatedly for precious metals manipulation. The bank that, court documents would later reveal, had been spoofing the silver market for years, placing fake orders to move prices, then canceling them before execution. In 2020, JP Morgan paid $920 million to settle charges of manipulating precious metals markets over an 8-year period. The Department of Justice called it a massive multi-year scheme. But here's the part that should make you pay attention. After the 2011 crash, after the manipulation was exposed, after the fines were paid, JP Morgan didn't stop trading silver. They started accumulating physical silver. They took delivery of actual metal from the COMEX. By 2012, JP Morgan held 0 registered silver. By 2018, they held over 150 million ounces. By 2020, over 300 million ounces. Today, estimates suggest their position exceeds 1.2 billion ounces when you include eligible inventory and ETF holdings. They suppressed the price, they got caught. They paid a fine that represented a fraction of their profits. And then they started buying physical metal at the artificially low prices they had helped create. Stage 1 and 2 executed in plain sight. Which brings us to right now, 2024 into 2025. Silver demand for solar panels has increased 400% since 2020. Each solar panel requires approximately 20 grams of silver. The world installed 350 gigawatts of solar capacity in 2023 alone. That's 140 million ounces of silver, just for solar. Electric vehicles use 25 to 50 grams of silver per car. EV sales are projected to reach 40 million units annually by 2030. That's another 50 to 100 million ounces of annual demand. 5G infrastructure, medical devices, electronics, water purification, industrial silver demand is exploding across every sector. Now look at supply. Global silver mine production peaked in 2016 at 900 million ounces. In 2023, it was 820 million ounces. Declining production. Most silver comes as a byproduct of copper, lead, and zinc mining. There are almost no primary silver mines being developed because the price has been too low to justify investment. The Silver Institute reports that 2023 was the 3rd consecutive year of structural supply deficit. Demand exceeded supply by 184 million ounces. COMEX registered silver inventory, the metal actually available for delivery, has dropped from 150 million ounces in 2021 to under 30 million ounces today. That's an 80% decline in deliverable silver. And who's taking delivery? Look at the warehouse reports. JP Morgan's vault holds more silver than all other COMEX depositories combined. The pattern is executing exactly as it has before. Stage 1. Price suppression through paper markets. Check. Silver's gold-to-silver ratio has averaged 80.1 over the past decade when the historical average is 40.1. Silver is priced at half its historical relationship to gold. Stage 2. Accumulation by major institutions. Check. JP Morgan has accumulated more physical silver than any entity in history. Stage 3. Supply crisis emerging. Check. Industrial demand exploding while mine production declines. COMEX inventories draining. Stage 4. Price explosion. We're here, right now. At the edge of stage 4, so why $85? Let's do the math that Wall Street doesn't want you to see. The gold-to-silver ratio currently sits around 85.1. Gold is trading above $3,200 per ounce. If silver merely returned to its 40-year average ratio of 60.1, silver would be $53. If it returned to its 100-year average of 40.1, silver would be $80. But here's where it gets interesting. During every major precious metals bull market, silver doesn't just return to average, it overshoots dramatically. In 1980, the gold-to-silver ratio hit 17.1. In 2011, it reached 32.1. These weren't anomalies. They were the natural result of silver's unique market dynamics. Silver is a much smaller market than gold. When capital flows in, prices move faster and further. At a 30.1 ratio with gold at $3,200, silver hits $106. At a 21 ratio, silver hits $160. These aren't fantasy numbers. These are the ratios that have occurred during previous precious metal cycles. But let's be conservative. Let's say silver only reaches its 2011 high adjusted for inflation. $49 in 2011 dollars is equivalent to $68 in 2024 dollars. Add the supply deficit that didn't exist in 2011. Add the industrial demand that is 300% higher than 2011. $85 isn't the ceiling, it's the floor. And JP Morgan knows this. Why else would the largest bank in America, the bank that was fined nearly $1 billion for manipulating silver prices lower, suddenly become the largest accumulator of physical silver in history? They're not collecting metal as decoration for their vaults. Let's check the boxes. Industrial demand accelerating, check. Solar and EV sectors consuming silver at unprecedented rates. Mine supply declining, check. No major silver projects in development, existing mines depleting. Inventory draining, check. COMEX deliverable silver down 80% in 3 years. Major institution positioned, check. JP Morgan holding over 1 billion ounces. Retail sentiment negative, check. Mainstream media calling silver dead money. Every single condition that preceded the 1980 and 2011 silver explosions is present today. But the magnitude of the supply-demand imbalance is larger. The monetary debasement is more extreme, and the institutional positioning is more concentrated. The pattern does not care about your skepticism. It does not care about mainstream financial media narratives. It does not care about the past decade of silver underperformance. The mechanism is mathematical. So what do you do with this information? You understand that the same institution telling retail investors to avoid silver is accumulating the largest physical position in history. You understand that the supply-demand fundamentals have not been this bullish since the 1970s. You understand that when COMEX registered inventory approaches zero, the paper manipulation mechanism breaks. You cannot suppress prices by selling contracts for metal that doesn't exist when buyers start demanding physical delivery. You understand that the next silver move will not look like the past 10 years. It will look like 1979 to 1980. It will look like 2010 to 2011, except the conditions are more extreme. You understand that industrial users are becoming increasingly desperate. Solar manufacturers are signing long-term supply contracts at premium prices. When manufacturers start hoarding, the squeeze accelerates. You understand that JP Morgan did not accumulate 1 billion ounces of silver to watch it sit in a vault forever. They accumulated for the same reason they always accumulate, to sell it at dramatically higher prices when stage 4 completes. You understand that the only question is whether you see the pattern clearly enough to position yourself before the price explosion becomes obvious to everyone else. You understand that when silver breaks $35, the mainstream will call it a bubble. When it breaks $50, they'll say it's unsustainable. When it hits $85, they'll say no one could have predicted it, but you can see it right now. The pattern is visible to anyone willing to look at the institutional positioning, the supply-demand data, and the historical precedents. The trap is not buying silver at these prices. The trap is believing the same institutions that are accumulating physical metal when they tell you to stay away. This is not prediction. This is pattern recognition. The same mechanism that allowed banks to accumulate gold before the 1970s explosion. The same mechanism that crushed the Hunt brothers and transferred their silver to institutional vaults. The same mechanism that crashed silver in 2011 and allowed JP Morgan to accumulate at the lows. That mechanism is entering its final stage right now. While financial media tells you silver is boring, while analysts point to the past decade of underperformance, while retail investors chase AI stocks and cryptocurrency memes, JP Morgan has already decided 1.2 billion ounces have already moved into their vaults. And the pattern, which has never failed to complete itself, is 3/4 through its execution. If you want to understand what happens next, if you want to see how the final stage of this pattern completes, if you want to know exactly how the transfer from institutional accumulation to retail distribution unfolds, you need to understand the mechanics of precious metals manipulation. You need to see the COMEX structure that makes price suppression possible. You need to recognize the signals that indicate when stage 4 is beginning. And you need to position yourself before the mainstream finally catches on. That is the pattern. That is the mechanism. And that is what is happening right now, while everyone focuses on the assets JP Morgan wants them to focus on and ignores the metal they've spent a decade quietly accumulating. Subscribe now if you want to see how the silver manipulation mechanism actually works, who controls it, and what the completion of stage 4 looks like when it arrives. Because it is arriving. And unlike every time before, this time you have the opportunity to see the pattern while it is still executing rather than understanding it only after JP Morgan has distributed their billion ounces to retail investors at 100 plus per ounce. The $85 trap isn't for them. It's for everyone who isn't paying attention.